Morning all and welcome to today's discussion. I'm Steve Watson, Director of Policy and Research at Cushon, and I'll be chairing today's event. And I'm pleased to be joined by the panel today, Baroness Altmann. Ros, good morning. Previous Pensions Minister and also a member of Cushon Advisory Board. Tom McPhail. Morning, Tom. Director of Public Affairs at the Landcat, our own Julius Pursaill, Strategic Advisor at Cushon. Morning, Julius. Renny Biggins, Head of Retirement at TISA. Morning, Renny. And
Morning.
Joe Dabrowski, Deputy Director at the PLSA. Morning, Joe. So welcome all to the panellists and welcome to everyone who's joined today's event. On this beautiful sunny day, and with just over a week and until the general election. So in terms of format, we'll have 45 minutes for the panel discussion and 15 minutes at the end for any audience questions. We've already had a number of questions come through as people registered for the event, but please ask questions within the chat. Somebody's picking those up in the background, and when we get to question time, we'll do our best to get those all answered. Just a reminder as well, I think it was in the registration email, at the end of the event, we'll be sending everybody a survey. If you could please complete that, that would be really appreciated. So without further ado, let's get started. So I think it definitely is safe to say that the past couple of years have been really active in terms of pensions, ranging from the value for money framework, pots for life, and of course, the rabbit out of the hat, the abolition of the lifetime allowance. So some initiatives are much further down the line than others. And I think certainly for me, the main question would be to the panel, and we'll come on to that, you know, what is likely to continue and what could change depending upon who actually wins. So one of the initiatives that's already, well, it's all ready to go and it's just waiting for someone to really press go, is auto-enrollment extension, which is about reducing the minimum age and getting rid of the lower earnings threshold. So in other words, it's getting even more people saving for retirement and of course saving from pound one. So it's theoretically already in the bag, but not yet, no go yet. So I think it might be described, Ros, as your baby. And so maybe I could come to you to sort of think about, right, what's stopping it, and whoever wins, what's, you know, the likely time, plan, process for the new government. Ros?
Yeah, so basically, I'm hoping that whatever happens in the election, this will be a new era where maybe there'll be more cross-party work with within Parliament that will determine the long-term policy for pensions. What we've lacked so much is the idea that somehow pensions are for people rather than just about money or scoring political points. Now, Labour has already committed to some kind of review. So as far as the issue there is concerned, it depends how wide-ranging the review will be. But my expectation is that actually it will be very wide-ranging and encompass issues for both state and private pensions. But there isn't much comment on pension policy in any of the manifestos, certainly outside the state pension. And there's a commitment to the triple lock for the state pension, but I suspect that is unlikely to hold for too much longer. and there should be a review of how we manage the state pension system. But more importantly, perhaps, for many of us on this webinar, and it's lovely to be here and just have everybody participating in this discussion with such an excellent panel, is that private pensions are a source of significant extra income for most pensioners, or could be and should be. And I'm hoping and I believe that the next government will be looking very carefully at extending auto-enrolment. We've already had the legislation, which I was honoured to take through the House of Lords, meaning that all the under 22s will be able to be part of auto-enrolment. That legislation has been passed, and also that contributions will be calculated from £0. That will bring a lot more people and a lot more money into the pension system already. Of course, it will cost the government a lot more in tax relief and cost employers somewhat more in contributions, as well as the employees who are enrolled. But the regulations have not been laid yet. So what we are going to see and need to see is action within Parliament by whoever forms the next government to ensure that the law change is then brought into practice with the regulatory requirements that will be attached to it. And that hasn't happened. And I think what we will need for that, and again, what we will need to see, which will be urgently required, is a resolution of the net pay problem, whereby the lower paid workers are paying a 25% extra for their pension and having lower take-home pay than they would do in a relief at source scheme because of the way tax relief is administered. HMRC has, again, promised to fix this, and it is consulting on that, and I've been part of those consultations, but we still don't have the regulations. So I would expect both of those things would need to happen at the same time. We've so far been promised that that will be next year. I certainly hope it will be, and that we can then get on with ensuring that low earners have better later life pensions than just relying on the state.
Thanks, Ros. And I suppose that is linked to really adequacy. And another issue around adequacy is the gender pension gap. And it's an interesting one, which arguably, well, actually, when I look at the manifestos, the only party that I can see that really has commented on this to date is the Liberal Democrats, who have specifically called it out. How important, over to you, I think, Renny, how important is this issue to the other parties? And depending upon the election result, what are we likely to see? Renny, you're on mute.
Apologies. It's incredibly important, Steve. There's various groups of differing sizes who are adversely impacted by pensions policy, and that will include areas such as ethnicity and religion and age, and those with disabilities. But I think the most prominent one and the most talked about gap is that gender pensions gap. And last year, the government for the first time actually published some official stats defining and measuring the gap. So the official definition is the percentage difference between female and male uncrystallised median private pension wealth around normal minimum pension age. It's a bit of a mouthful. Also, the stat that it produced was saying, at the moment, the gap stands at around 35%, which is huge, reducing marginally to 32% when you only consider employees who are eligible for AE. The biggest reason for the gap we know is the gender pay gap. Median pay for all employees in 2023 was 14.4% less for women than men. And tied into this is working patterns as well. We know women are going to be far more likely to leave employment market, either temporarily or permanently. or maybe move to part-time to raise a family or care for elderly relatives. Another contributing factor is divorce. Pensions are usually considered a joint asset and would need to be split or shared on divorce, or when a civil partnership is dissolved. You know, after all, pensions wealth is perhaps the biggest, or if not, the second biggest asset a family or a household has. But despite that, around 70% of divorce settlements don't include any splitting out on the pension side of things. And where it does, evidence suggests that pensions aren't always valued fairly. On the state pension side, Ros was talking about a little earlier, you know, we have seen unequal treatment between men and women on that in previous years, but we have seen some reforms which are levelling that up. And I believe it's expected that a full equalisation will be achieved by the early 1940s. So we've still got a little way to go there. So very brief background on why it exists. Let's talk general election. As you say, Steve, you know, the party manifestos are all out. They're all there for us all to see and read. And only one of them specifically mentions that gender pensions gap, which is the Lib Dems. You know, I don't think you could link it to anything in the Conservative manifesto. But as Ros also mentioned, you know, we've got this pensions review that Labour are committing to. That's a bit vague. We don't know what the remit of the review is at the moment, and maybe Labour don't really know it yet either. But any sort of pension related aspects which are brought up as areas of concern could slot into that review. So perhaps it's a bit of a catch-all. But you know, in reality, you know, I think we need to place our bets on the review here, because in all honesty, it looks like Labour are going to come romping home here. So what could they do on the pensions gender gap? Well, number one, they could remove or lower the earnings trigger for auto-enrolment from the £10,000. So that would bring more employees into auto-enrolment. That would help remove some of that problem for part-time workers not being eligible for AE, and 74% of part-time workers are women. Number two, we could change the annual allowance to a lifetime contribution allowance. This would then offer those who don't have any earnings for certain years, which are often women, taking those time periods out from the workforce, as I mentioned. It would provide them with the opportunity to make up for some of those shortfalls in later years, if and when they're earning again. Number three, pensions need to feature much more prominently in divorce proceedings and dissolutions. So we need to make sure all parties involved in those divorces, and that includes the solicitor as well, you know, are fully aware of what the benefits are that are being given up with those pension entitlements, and perhaps even mandating pension splitting could be considered at a later point, but I wouldn't want to advocate that as a first step. Number four, the new government report I mentioned at the start that came out, well, this should be a mandated annual report, and government should have a statutory requirement to report to Parliament on the latest gender gap details and the plans they're tackling for it. Number five, we'd love to see the creation of a long-term savings and investing commission to provide a little bit more stability to the framework. If such a group were created, then this should definitely be included there within the remit. But you know, largely the gap exists as a product of employment practices and sort of accepted norms, or once accepted social norms that have been there for decades. So there is a bit of a limit on how much pensions policy can do here to close the gap. Other ways to help gradually reduce it, I guess, would definitely include more education at earlier ages to raise awareness about it, the role that pensions and savings play in financial and mental well-being. And here, you know, we all have a part to play there, government, employers and industry.
Yeah, thanks, Renny. Joe, anything to add to that?
I think Renny's covered a lot of important points there. I think the other element I'd just draw out is it's on the sector and also employers to think about how do we adapt services, communications, and potentially products to support closing the gender pensions gap. I think largely I agree with Renny that a lot of this is employment practice. Some of it is historical. But actually, if we recognise that this is quite a big problem, we wouldn't sit around and accept this outcome in other forms of society, would we? We think about that we have to address this over long term. And some of that might be introducing more flexibility, different types of communication into AE as we go forward. So targeting people when they begin to think about their career. Do they want to save more earlier in order to offset some of the risk potentially that they may have a career break later, and that could apply to all genders, and also supporting people back into work and thinking about things. There have been creative suggestions in the past about, can you share contributions or other things in the future? I think we have to look at a range of options, but if we can address some of those big societal issues, that's going to make the biggest difference.
Yeah, I would agree. And I mean, it goes back, and, you know, there's no one single answer, but definitely goes back to the question earlier to Ross about auto-enrollment extension. And of course, most women are more likely to have part-time jobs, multiple jobs. So that's a really important policy initiative. Now, the other thing that is, I think, for most of the parties is featuring really big, is investment in UK PLC. And it's already been kicked off by the Conservatives with the Mansion House Compact, which we are a signatory of, and so support it. Labour have promised to go further, so I think it's safe to say that they support the Mansion House Compact, but believe that it could go even further. And Reform UK, in terms of their manifesto, are looking to go for a more prescriptive investment model, which is funding national infrastructure and utilities, and it sees a funding mechanism of half from pension funds and half publicly owned. So I suppose the question is, the manifestos aren't particularly detailed, but how important is investment in the UK PLC to each party, and where do we think that they will land? And, you know, even before general election was announced, we've certainly been in lots of discussions with interested parties about what barriers exist and you know, how they could be removed. But maybe over to you, Julius. I mean, what are the barriers? You know, it is a really prominent part of at least the two main parties. How do they go forward with this, and what are we likely to see?
Well, Steve, as you say, there's broad consensus, isn't there, about the need to find probably very large sums of capital to drive both the growth agenda and more generally to invest in UK societal infrastructure. And it's not clear in any manifesto or in any broader comments from the parties where exactly this large sum of money is going to come from. And as a consequence, I think all parties will view pension fund assets with interest and consider what steps they might take in order to release some of those assets to flow into UK growth and societal infrastructure investments. So, as you say, what are the barriers? Well, as we know, trustees are ferociously resistant to being told what to do. So mandation, I think, is probably a step too far, at least in the short term. There's been some interesting conversations around whether there's a social contract in place here in return for the generous tax reliefs that pension contributions enjoy. Perhaps the quid pro quo ought to be some investment in UK.
Julius, I think we might have lost you there. Ros, while we're waiting for Julius, what's your view?
Well, from my perspective, it's an absolute no-brainer for any government who is, you know, we know that there is a massive budget deficit. We know that the economy desperately needs more infrastructure spending, more on social housing, all these elements that are long-term investments which could provide steady returns. So not targeting the pension assets that are being put aside week in and week out, month in and month out for people's futures, by finding a way to ensure that they do go into the UK economy, would be a derogation of duty. I have to confess, I am very disappointed that the current government hasn't done more to actually wake up to the opportunity. You know, we're spending £70 billion a year on tax and NI relief. People's pension contributions are being supplemented by that amount of money from taxpayers. Not a penny of it needs to go into the UK at all, so it can all support non-UK countries. And we know that in all other countries, all other major countries, their pension funds have a significant overweighting in their domestic assets. Whereas in the UK, it's astonishing to me that our pension funds, which used to be, when I started managing pension funds in the 1980s and beyond, about 50% invested in the UK equity markets in order to get the high returns, but also to provide a really strong source of domestic capital that markets and companies could rely upon even through less favorable times. For example, Australia, Italy, Japan, France, the USA even, Singapore, all of them have huge exposure to their domestic market, way above any MSCI weighting. In the UK, and including, I'm afraid, even the Parliamentary Pension Fund, the allocation to the UK stock market is less than 2%, even though it's 3.8% of the global index. So something has gone wrong. I think if the government were to mandate that in exchange for tax relief, at least 25% of any new contributions, that's just a figure that I think is very easy to justify and would still bring a lot of money in each year, of the new contributions need to be invested in UK assets, UK listed assets, real assets, social housing. If you don't want the tax relief, you're free to invest wherever else outside the UK. But if taxpayers are putting money in, I think they need to know that some of that is actually going to benefit them and the economy, and also be a reason why the people who are saving for pensions should be able to look forward to retiring into a better economy in future. This is huge sums of public money. The government hasn't got alternative sources of funding to put into UK infrastructure and housing from the public sector. So why not use this pension money rather than taking the tax relief away altogether, which might be an option that's being considered too.
Thanks. So Julius, thanks for rejoining. So on that, maybe we can pick up where you left off, which is, so Ros is talking about there as a, an alternative in terms of mandating in return for tax relief. But one, how would that land with fiduciaries? I think that was the point that you were trying to make before you left. And also, if it's not mandated, what are the barriers?
Yeah, absolutely. Well, look, Ros, I agree with much of what you've said. I think mandation is always very tricky for fiduciaries. They do not like it. But I think the argument you advance is a very, very robust argument. I think it may not be necessary. So let me talk about geography. I think we may have reached peak geographic diversification. So why on earth might I say that? Well, the world's changing, right? So while we've been disinvesting from the UK, the world's changed. And I think there are many reasons now why we might want to voluntarily increase our allocation to the UK. So the world's deglobalizing. There are fewer benefits as economies become arguably more isolated that might flow from diversification. You might want to be investing in things like, for example, UK energy security, UK food security. You may be particularly concerned and more concerned about UK inflation than you might be about other sources of inflation. So I think there are arguments to suggest that investment in UK PLC is actually arguably attractive from a fiduciary's perspective. As far as Cushon's concerned, we have other reasons why we think this is a good idea. We think there's additional value being left on the table, which is easier to extract from UK-sided assets. This is all to do with the Cushon agenda of connecting people using our technology with the changes in the real world that their investments are making. It's easier to do that with UK-sided assets. So our trustees have a very good reason for investing in UK over and above trustees more broadly. So I think geographic issues, yes, important, but I think there are potential solutions there. Two other issues, two other obstacles, one of which is price. If we really want to generate investments in UK venture capital, it's expensive. And so what do we do about that? Well, we need the regulation to incentivize the right forms of behavior. So what do I mean by that? Well, if you have, for example, a backward-looking value for money framework, which focuses on price and ex-post returns, it's very hard to get VC into the mix. If your principal measure of value is a forward-looking metric, which attributes attractive levels of return to VC, it's much easier to get VC into the mix. So let's please have a value for money framework which incentivizes the behaviors that we want to see. I think the final point I'd make is about risk. Now, for some schemes, VC, some DC schemes, VC may be excessively risky. For other schemes, other forms, maybe even of debt assets might be too risky. There is an opportunity for the government to come in, as happens in many developing economies, and take some of the first levels of risk off the table and make it easier to deploy pension fund capital into both debt and equity assets in the UK.
Brilliant. Thanks, Julius. So, Tom, I'm going to come to you now, because I think there's as an extension of this, or at least in the same topic in terms of investment strategy, another big point across most of the parties is ESG. And we have the Conservatives. They've already enacted the reporting requirements for pension funds. Labour are aiming for the UK to be the green finance capital of the world. The Lib Dems giving new powers to the regulators to act where pension funds aren't doing what they should be doing. The Green Party calling for a total removal of fossil fuel assets. And of course, we have Reform UK wanting to remove, and I don't think this would have been a surprise to anyone, wanting to remove all net zero related objectives. Where do you think the two main parties are likely to land on this?
Yeah, really good question, and it as you say, it all kind of connects up together. Oh, I've lost my video. Put that back on again. So it's interesting looking at the manifestos. You see the Liberal Democrats have talked about actually redefining fiduciary duty to encompass alignment with the 2015 Paris Agreement. You know, I take Julius's points around mandation of fiduciary duty. That can get problematic, and I think Ros made some really good points around, you know, where you can pull levers to steer and persuade trustees towards outcomes that you particularly seek. I think it's interesting when you look at the Labour policy paper that came out earlier this year, where they talked specifically about tackling the barriers to pension schemes investing more into UK productive assets, and setting out proposals to bring about an approach that will benefit both UK PLC and UK retirees. And I think it's significant the way the Overton window has shifted now, whether it's the Mansion House or what I talked about there with the Liberal Democrats or Labour. There is a consensus now that it is okay for government to intervene in this space and direct what pension funds do with these assets. It is going to happen whoever wins the next election. Really all we're debating about is how it happens and how far down this road we go. When you look at the OBR report on fiscal risks, they talk about the cost of decarbonising our energy grid at over £300 billion over the next 30 years. That's some pretty big cheese there. That's going to require a lot of money. And if you were a policymaker, why would you not be looking to the pensions industry to play a significant role in all of this? And I just want to bring it back round to a point Ros made earlier on. I think the Turner Commission did an amazing thing in creating this consensus and getting the participation rates in pensions back up through the auto-enrollment program, and that was brilliant. But the consensus role that it played in delivering that outcome was critical. Labour, for example, if they win the election, have talked about this review of pensions. I think there was a really powerful argument for whoever wins the next general election, for them to appoint an independent commission that would have that authority and authenticity to come up with a set of solutions that is slightly less political, that could bring together questions around taxation, around adequacy, around investment strategy, around the serving of UK PLC, build a consensus around all of those issues, bring it back to the government of the day to then allow ministers to decide on how to implement it. But I think that consensus forming focus and that function would be critical, and would give government air cover to then make what will be some pretty tough decisions around all of this, and to take the opposition along with them, which will also be really important in all of this.
Yeah, and I think, Tom, and maybe, just to add sort of context to that. So we're talking about big money here, when we talk about pensions and what they can be doing, whether we're talking about ESG or we're talking about invigorating the UK economy. Ross spoke about the cost of the taxpayer of tax relief, £70 billion. And of course, we have total assets under management in UK pensions of like £3 trillion. So we're not talking about insubstantial amounts of money. Julius, any points to add to Tom's?
Yeah, thanks, Tom. Yeah, agreed. It's really important this stops being party political. I mean, as you mentioned, Steve, this is the area where we have the biggest difference between the parties. It's a huge difference. This shouldn't really be a matter of political debate. These are largely scientific facts that we're dealing with. And we can debate how large the impacts are, how large the price tag is, but these are largely scientific facts. So we do need to deliver a consensus. I think that's exceptionally important. We've seen what happens if you pursue a war on woke. In the States, asset managers who implement ESG are being sacked by some states, and asset managers that don't implement ESG are being sacked by other states. We definitely do not want to go there. So what policy prescriptions would I be looking for to help fund that very large cheese that Tom described? Well, there are some policies actually which I think are straightforward, and I'd use the Conservatives' offshore wind policy as a good example. We have the second largest installed offshore wind capacity in the world after China, and that's a direct result of Conservative policies. Not only do we have the largest installed capacity, but when energy prices spiked, consumer bills were kept down by the money that the renewable operators, offshore wind, paid back into the system to reduce customer bills. That's a great policy, which should have broad cross-party consensus. But there will be some that are much more painful in terms of the investment required. So what could the industry do to help? Two things. First of all, really important, a technical point, but we have got to close the gap between the output of the econometric models that TCFD reports generally rely on to estimate the scale of climate risk. Pension fund trustees are systematically underestimating the scale of the risk. We align those outputs with what climate science is telling us. The risks become a great deal larger and trustees become a great deal more motivated. We're not obliging them to do anything, but the writing will be on the wall whether they choose to invest to support a successful transition, or if they don't believe in a successful transition, then invest in adaptation technology. We will need one or the other. In fact, we need both. So that's a very important policy prescription. Second one, we've talked about fiduciary duty. I think we've gone down a bit of a rabbit hole with fiduciary duty. It's increasingly become differentiated between financial factors and non-financial factors. I think it's an unhelpful differentiation. We're currently focused on the size of the fund. That is very restrictive. We should be focused on members' standards of living in retirement. It will be very simple to issue new guidance to encourage trustees to think about what might my investments do to enhance my members' standards of living in retirement. Local authority pension funds already invest in social housing in their borough because they know it's in their members' interests, because their members will need that social housing when they retire. We can do the same thing on a UK broad basis with UK societal and climate assets, just with very marginal alterations to guidance. No legislation, no regulation required.
So, Julius, just on that, in terms of, the power of it to sort of also link to member outcomes, a big factor for that is also about people feeling comfortable about making decisions, whether that's where their money's invested, how their money's invested, or how much they're invested. And they need to have a sense of permanency, and that if they make decisions today, it's not going to sort of change tomorrow. And a big one around that is tax. And of course, we spoke about earlier the Conservatives, the rabbit out of the hat, abolishing the lifetime allowance. But the Conservatives in their manifestos have issued now this pensions tax guarantee. Labour not really talking about it within their manifesto, but threatening, well, no, they were threatening to reintroduce the LTA. Then they pulled back. Then there was a little, but I think the latest is that they're not going to be reinstalling it. And then we've got the Green Party wanting to equalise pensions tax relief to the basic rate of income tax. I've heard that one before, not necessarily just from the Green Party. But what are the two main parties likely to do? Joe, would you like to answer that?
Thanks, Steve. I think the two main parties have been relatively silent on the bigger question of pensions tax relief and reform. And you just look at the knots everybody twisted themselves into over small changes around thresholds. And clearly, nobody wants to frighten the horses effectively in voters ahead of the election. I think it does also come up as a kind of reoccurring issue for the pension sector to discuss and debate. We recognise that there's a large sum of money that is there providing pensions tax relief. We also recognise that the government coffers are a little bit thinner than we'd all like, and therefore you can kind of marry the two together. But I think you recognise it's also incredibly difficult to change the pensions tax relief system. Everywhere you turn, you upset an employer, you upset a saver, you upset the pension sector. The treatment that applies and could be utilised in the sector is very different between public, private, and unfunded. There are a whole host of terrible, knotty issues. And so you can see why politicians look at it and think, oh, actually, I really don't want to go there. And for us, the first thing that any incoming government should do is sort out the lifetime allowance regulations, because we've had this terrible bodge job, frankly, of introducing regulations, changing them again because they weren't right, and then realizing that they weren't changed properly the second time, and they still need to be fixed. And people are halfway through the year thinking, well, how does this apply to me, and what penalties might I incur, and what happens with it? So I think it is a very difficult issue. I think an incoming government is quite unlikely to want to grasp the metal immediately and think about pensions tax relief, especially when you've got a big agenda of other things to think about. If you want growth, in particular, Labour has talked about growth, Conservatives have talked about growth too. You're not going to want to distract your parliamentary time, your political will, your capital, necessarily going down the route of looking at pensions tax relief. I think it might come later in the decade if the fiscal situation in the UK hasn't improved. It does feel more difficult. We will have also been further along the transition from most people saving into DB to most people saving into DC. And so that makes a difference potentially in the way that you can think about it. For us, there are kind of 5 principles that you could apply if you think about pensions tax relief reform. It's kind of, we talked about a little bit already, promoting adequacy, making sure the incentives go in to help people save for retirement, encouraging people to make the right decisions at retirement, that it's fair for the employed and the self-employed, and helps people save for retirement. Some of the changes that have been suggested around tax relief have been, well, do something for the public sector, we'll do something for the private sector. That clearly doesn't wash. People interact in employment in different parts of it's different parts of sectors throughout their career. You can't have a even more complicated system. Something that ideally is simple to adopt and administer for employers, for people to understand, and to transition from where we are to where we might be in the future. Picking up your point, Steve, so it's enduring and sustainable. People lose faith if their taxes constantly change, if they think about the rules about their pension constitution. People just about understand how pensions work at a kind of high level. If you make it really complicated, really hard to understand, it just puts people off, and people will lose faith in saving because I think, well, I won't trust it, it will just be gone, or they'll have changed it when I get there. And then thinking about how that changes impacts back through into kind of wider economy. Those are things to think about. I think it's not an issue that people are going to pick up and run with immediately. I just think it's too difficult. I think there'll be fixes around the edges about the system that we've currently got and the changes that have been made, but a longer term thing to consider.
Yeah, I don't disagree with you, Joe. I mean, I'm just with you on your point about if you do nothing, please, within the first 100 days, at least introduce all the legislation changes that are necessary for the abolition of the LTA and fix all that. So people, because we still have people being warned with warnings from HMRC themselves saying, if you look like this or you're considering this, don't hold your decisions. We recommend that you don't. We would advise you not to make any decision yet. Hold off, which is not a great position. Renny, can I come over to you? Anything to add?
I would like to re-emphasise 100%. Got to finish off what's been started on the new lump sum and lump sum death benefit allowance regime, because there are 8 or 9 different scenarios there where people are potentially impacted and stopped from accessing their own pension funds, you know, and the HMRC guidance at the moment is we suggest you delay taking your pension benefits. So we desperately need that resolved and completed as a pensions priority for the next government. But let's just be a little bit speculative here about what might happen anyway. You know, Labour have said they have no plans to change pensions tax relief. They have said that fairly recently, but maybe you wouldn't want to rule out 100%. You know, it is estimated that if you remove higher rate tax relief, so everybody just gets to basic rate, it could result in sort of NI and tax relief savings of around 14.5 billion each year. But it's also perhaps quite hard to argue why it's appropriate to provide higher savings rates of tax relief to those already wealthy people over and above those that are less well off. And that would be keeping sort of to a traditional Labour core value. Hideously complex to bring in and implement, but let's see if and it would take a very bold government to do that, but we'll see, you know. I think one area that could potentially be ripe for reform of pension death benefits. We know currently they're really generous, allowing people to pass their pensions wealth on, potentially without the beneficiaries having to pay tax on it until their money is withdrawn. You know, to the extent that more wealthy individuals actually save into pensions and bank all the tax relief, the higher rate tax relief, without having any intention of ever touching it at all. You know, it's all done from an estate planning perspective, because pensions are so generous in that respect. So I think potentially, you know, tax relief or pension death benefits could be on the cards for looking at here. And whilst I think it would probably be politically damaging to include them in IHT, because IHT was only ever designed to really hit the very wealthy individuals, and bringing in pensions into that would bring a lot more people into the IHT calculations. Potentially, you could see that pensions were automatically taxed on death. So any pension that was above a certain value would be automatically taxed, irrespective of how that the pension was going to be taken. And having spoken to a lot of pension professionals in recent months, a lot of people said they would much prefer that than any further tinkering around with things such as the lifetime allowance. The other sort of thing I think that potentially could be on a radar and a lever to pull could be tax-free cash. You know, perhaps it could be restricted to a reduced level or a percentage. To do this retrospectively would be really harsh, though, and pensions policy isn't generally made retrospectively. So that would mean we'd need another set of protections in the form of tax-free cash protection. So that just, it does create a further sort of set of complications. But I guess the bottom line is whatever tax changes are brought in, they're likely going to be designed to sort of raise revenue or reduce existing expenditure. Just going back to the Labour review, which has been mentioned a few times, you know, we really believe it'd be beneficial to include any consideration of any sort of tax changes whatsoever to allowances, tax relief. You know, that has to form part of the remit of that review. Because you've really got to consider closely the implications, the limitations, and the opportunities for the pension regime more holistically. So this review's got to be, in full collaboration with industry to ensure the framework's delivering sort of fair outcomes for everybody, and future-proofs it from further short-term interventions, which, as Joe was alluding to, really does undermine consumer trust and engagement in pensions, and ultimately will stop people from wanting to invest their money into something that they might not be able to touch for 40 years or more.
And Renny, the biggest concern for me as well is decisions that people make when they get to 55. And I've heard it say in research that we've done as well, a bird in the hand is worth two in the bush. And it's sort of, that's not great decision making. But when you have people who aren't convinced about the steadiness of pension tax policy, then maybe, that's what you expect. So we need perhaps, and maybe that comes to Tom's point earlier, which was an independent commission. Maybe that would add some more stability. Okay, so I thought we could just have a quick round of questions before we get to audience questions, which is really, I spoke about earlier about there are these policy initiatives that we were all busy with and all excited about and reading about, and then they suddenly had to stop, okay? So it's, for each of you, what do you think about each of these initiatives in terms of their deliverability? So Tom, maybe I'll come to you, which was perhaps one of the most controversial of these initiatives, Pot for Life, and what you think the future might hold for a new government.
Well, that's a really good question, and the short answer is, honestly, I'm not sure, but here's the problem. The current government has put in train work on default consolidators to deal with the existing stock of small pots, and that looks like hard yards, but it's at least it's a plan and it's doable and will help drive consolidation across the marketplace. But it does nothing for the flow of small pots. And currently there are essentially only two answers on the table. I mean, there's member-led consolidation of existing small pots, and maybe the dashboards will help there, but I don't think anyone believes that, left to their own initiative, pension scheme members are going to consolidate all these millions of small pots and even keep pace with the existing flow of new small pots that is currently pouring into the system every year through the way that auto enrollment is designed. And there are only two answers on the table here. Either we do pot follows member, which is what Steve Webb advocated and continues to advocate very vociferously as a solution, where the small pots get picked up and moved along behind you after you've changed jobs. Or there's the lifetime provider model, which turns elements of auto-enrollment on its head and undermines the existing relationship between employers and the pension provider, but also puts the individual at the heart of the system and gives them agency and control over their pots, and solves the problem of the transfers, because once you've got a pension pot, you could just get your new employer to pay into it. Technology issues around all of that, how we make that simple for employers. So neither of these solutions is simple. Both solutions have their proponents. I'm personally a big fan of the lifetime provider model. I think it's a better forward-looking solution, and as the marketplace consolidates, it makes more and more sense. But we've had a government consultation on the idea of the lifetime provider. We've had a lot of work from industry working groups on it over the last few years. We've had work done on pot follows member that got shelved. Labour have sort of tentatively said they're kind of supportive of the lifetime provider idea, but I'm not sure they've really thought about it that hard. So this is an issue that is not going away. It's costing already £250 million in wasted admin costs every year. And who pays for that? The members pay for that. We've got all these dormant pots. We've got poor decision making at retirement. It is a problem that needs fixing. And I really, really hope that on the other side of the election, whoever's holding the steering wheel, they have the courage to grasp one of these solutions. My preference would be lifetime provider, and actually drive forward with this solution, because it needs fixing.
Yeah, and I think, Tom, it links to, when you look at the arguments as well, it links to increased ownership, which links to better decisions. But all of these policy initiatives all have to, and to be fair, in all the manifestos, all using different language, they talk about better outcomes, or dealing with savings adequacy, which has been on the agenda for a while. So Ros, what do you think happens to the question of dealing with ensuring saving adequacy? You're on mute, Ros.
Classic. Sorry, auto-enrollment has really done huge amount for coverage, but adequacy is still a big issue. And what I feel is potentially on the table for a major review is who is responsible for increasing contributions. The government has already legislated for bigger contributions from both employers and members, and bringing more members into the pension system by including younger workers. So the pound zero extension and the number of people coming in will already mean better pensions and has already improved adequacy. I wonder, what is the limit on how much you can ask employers to chip in, and how much you can ask members themselves to be cajoled into putting in rather than wanting to do so and being enthused and engaged about saving for their future or investing for their future, which is a better way of putting it. So I think that there is a case to be made for saying the auto-enrollment minimum contributions are where the government responsibility perhaps ends, and then both employers and individuals, and many employers already offer matching top-ups for the extra above the minimum, are left to decide how much more, with the encouragement and perhaps some incentivization from the pension providers themselves. At the moment, the pension providers' role in adequacy seems a little bit unclear, because normally in any consumer industry, if you want to sell more of your product to a customer, you try and market to them and explain why they should buy more of it and why it's so good for them and why it's better than the other types of product similar that they could buy, whether that means my pension is better than the competitor's pension, or my pension is great, but you could do some more whenever you can and get the extra tax relief. That's one way. The other way could be, and I don't think this is the most likely scenario, but it will be, I'm sure, on the table, to compel the minimum contributions under auto-enrollment, so that you don't need to spend the tax relief money in the minimum. You might want to say either that the extra is shared between the employer and the employee, or put all of it on the employee or put all of it on the employer, the extra 1% that's the equivalent of basic rate tax relief in the minimum. And then any taxpayer incentives go to top up the minimum, which should bring in more money. The trouble is that it's likely to bring in more money from the higher earners rather than from the kind of mass market low earners. So I still think it comes back to this idea that, pensions are a brilliant product. They really are. They are unquestionably the most tax efficient way to spend your investment dollars, as it were, unless you're extremely wealthy and can take advantage of VCTs and all sorts of other things like that. It's free money from the employer and it's free money from the taxpayer at the moment, but it's not being presented to consumers as anything great. The messaging is too negative, in my view. It always has been, and it still is. You're not doing enough. You're going to be very poor. If you don't have more than that, you're going to regret it. It's very negative, and I think people respond better to positive.
Yeah, I agree. Tom, thanks, Ros. Tom, you've got your hand up.
Yeah, no, I mean, I agree with everything Ros said there, as is often the case, but I just wanted to add to that the interesting challenge that is evolving here. So auto-enrollment's done a fantastic job increasing participation rates it's also missed a lot of people, and the 2017 reforms still haven't been implemented. So increasing numbers of low earners, part-time jobs, self-employed, gig economy. There are millions of people that auto-enrollment has missed, and there's a lot of unfinished business there. The 2017 reforms, if we ever get the regulations Ros talked about, that will help. But the other point I want to make on this is we've come from a world where the majority of people moving into retirement own their own home. Currently, it's high 70% of people in retirement own their own home. Within 20 years, that will have dropped to around 60%. You're going to have a substantial minority of people in retirement who no longer own their own home. That world is changing. Now, what we're asking them to do is to reduce their standard of living today by pouring money into a pension. They'll build up relatively modest savings in some cases. They'll get to retirement. They will ultimately end up dependent on housing benefit, which is means tested. They will end up having saved money to no betterment for themselves in retirement. That is not a problem that existed when the auto-enrollment architecture was built 20 years ago. It is a problem that has emerged over the last 20 years. And I think that's going to be a really interesting challenge for policymakers, because yes, we need higher contribution rates, we need more participation rates, we need better adequacy of pension provision, but also for increasing numbers of people, that equation won't work quite so well. And that's not going to take any simple answers to solve.
Yeah, I think maybe with all that from Ros and Tom, thanks, whether it's Labour, Conservatives or whoever, we need it almost as if we need a total review. We need a total redesign, maybe. And you've got the controversial pot for life, which shouldn't be arguably controversial, and then it also links to the independent commission. Joe, we're sort of running out of time. Have you got a quick point?
Yeah, I'll be very quick. I think it's a very good category of thing that might fit into the Labour pensions review if they propose it. I think just bearing in mind, all of this is also just a risk transfer. It's either employer, employee, or the state is going to pick up the cost for this. And if people have inadequate pensions, they're going to rely, as Tom said, on housing benefit or welfare or other types of support. And we have an aging population. So there is an issue that we need to think about: who is bearing the risk and how do you fairly apportion that? And what does that kind of roadmap look like? So I think that would be a really sensible thing for the review to think about.
All right, thanks, Joe. So thanks, panelists. I think we need to move on. We've got a few minutes left to take some audience questions. We've got a few, but I'm just going through them to see what perhaps we haven't already answered. And actually, this is a good one. So, and maybe I can come to you, Tom, first of all. So actually, a lot still on the table, a lot to do. Realistically, though, are pensions likely to feature in the first 100 days of a new government? And if so, what will be the immediate focus? And I'm assuming part of the answer is going to be sort of the remaining legislation to make the abolition of the LTA work.
Yeah. Well, hopefully that gets done. I think, you look at, we've talked already about productive finance, mansion house reforms, I think that is where the focus will be: stimulating economic growth, social projects, all the stuff we've talked about already. I think that's the lens through which policymakers are currently looking at pensions policy. And then there's lots of other stuff that's in train that will continue, things like the value for money, default decumulation, and so on. A couple of things we haven't talked about. I mean, I think the pension tax reform, look at the size of the majority, the size of the government, the amount of political capital they've got to spare. That will be a big determinant in how radical they can afford to be in NSC policy changes. And actually, not just the size of the government's majority, but also the shape of the opposition. I think we're at one of those pivotal general elections when the shape of the British political landscape is changing before our eyes. So let's wait and see where we land on the 5th of July for a lot of that stuff. One thing we haven't talked about that I think perhaps we should, the minimum age at which you can access your private pension savings. It's been 55, it's going up to 57. I would not be at all surprised to see a government coming in and saying, look, this is ridiculous. We're going to make it 60, and we're going to do that quite quickly. And there need to be protections and all of that. And we don't want to whip the rug out from under people. But to me, that's a political no-brainer. And other stuff we've talked about, like death benefits and taxation and so on, I think are also likely to feature. So I'll stop there.
Brilliant. Thanks, Tom. Okay, another question, and if I could come to you, Julius, we've got sort of a couple of minutes literally left now, but I think this is an interesting one. The two main parties both talk about, and I mentioned earlier, albeit using different language in their manifestos, but it boils down to both talking about improving member outcomes and together with more investment in the UK. Or potentially prescriptive investment. Are these two principles compatible?
Well, as I intimated earlier with my comments about fiduciary duty, I think they are. Some fiduciaries would definitely disagree with me, but I'm completely persuaded that they are. I've been a trustee for many years, I'm not currently. If I were a trustee and I were asked to make investments in societal infrastructure, because it's in my interests, in my members' interests, that they retire into a society with functioning healthcare, functioning road network, functioning public transport, yes, I would be very comfortable making those judgments under the current definitions and guidance of fiduciary duty, but we can do a little bit better with renewed guidance.
Thanks, Julius. So that brings us right to 12 o'clock, so the end of today's event. So first of all, apologies there are a few questions, but I have gone through them, and I think throughout the session we have answered most of them, if not all of them. So big thank you to Renny, Roz, Julius, Tom, Joe. Thank you so much for your time today and for interesting insight. And yeah, I can't believe it's only just a week away, so we haven't got long to wait. And again, thanks for everybody else who's joined. We've actually had a really good turnout today. We thought it would be popular, but I think it's proved even more popular. And again, just a reminder, if you could complete that post-event survey, we'd be really, really grateful. So thanks, everyone, and have a great day.
Thank you.